Hello traders, Gary Wagner here, just after 10 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 28th day of March 2014, and this is the daily report for gold and silver, our weekend review. As we finish up the week, and it has been a devastating week in terms of the action and lower pricing in the precious metals markets, but at least for Friday, it seems as though we're going to close anywhere between unchanged and up a couple of dollars. 1292.57, that's our current print on the screen, puts it up roughly $1 on the day. The low has been 85.90 and the high has been 1390 cents. Current print, as I said, roughly up $1 on the day. Silver also staging a small bit of resiliency. As you can see, 1978 current print on the screen, the low 1955, the high 2001, currently putting it up about 10 cents on the day. More about silver towards the end of the show. Traders, there's no doubt, we witnessed the continuation of a pretty dramatic retracement. When you consider that the market was at about 1391, is at about 1291, 1292 and change, we can see that we have roughly seen this market drop, about $100, and do so over the last few days or week and a half. However, when we put it into context, and that context being a dramatic $200 rise and then a 50% retracement, although steep, although giving up half of the gains, the fact of the matter is it does still fall within lines of a basic impulse set moving up. And when I say a set, what I'm referring to is our 5 count, 1, 2, 3, 4, 5, in which 1, 3, and 5 are our impulse, and our corrective waves, of course, are always going to be 2 and 4. Now, there are actually a couple of indicators, a couple of technical studies, as well as techniques that are pointing to a potential bottom in the market. And before we really go into where I'm looking for the market to go, I want to talk to you about the setup of our next trade, because I think it's going to happen early next week. And here's what we're looking at. First, let's talk about the fib retracement. We've been mentioning it all week, but when you consider that we've had a dynamic $200 move, and then look at where the market seems to, at least for the time being, have stabilized, it's stabilizing in an area where you're just past a 61% retracement, and the 61% retracement is of a shorter move. In other words, I've broken this rally up into really two components. The first component is its move from 1183 all the way up to 1391. Second component is 1236 up to 1391. And I do that because you can see as the market came up, hits this top here, and then moves back down. So it is a sub-count within this longer wave that we've been looking at. So when you consider that we've retraced roughly 50% of the overall move, 61% of the most recent rally, it is falling into alignment. Now, that in and of itself doesn't signal a bottom, but it signals a point in which we're going to look. But there are some indicators in terms of the candlestick patterns, as well as our Andrews pitchfork, our cascading channel lines, that are kind of setting it up that we really could be seeing that as a potential and the conclusion of this most current recent sell-off or corrective wave. So I've gone ahead, I've pulled up our daily chart. On this daily chart, we have the same fib retracements. We've got it drawn in 2 points, both going to the top, just at around 1390. And the fact that the market is getting a little bit of support in this area is absolutely not conclusive evidence that we have seen a bottom. We'll get more evidence and more data as next week begins to unfold as to whether or not we've got a real pivot point here. The caveat to that is that if the market does not hold this level, the next real levels of support come in at 1270 and then 1262. Now 1262 is a 61% retracement of this entire rally. So if we were to breach that particular point, meaning the 61% retracement point, then effectively we cannot continue to have a bullish model that looks for a impulse set as opposed to a corrective set in terms of the waves that we're going to be looking at. So that's one piece of data that's alluding to a potential bottom, or conclusion, I should say, of this current sell-off. Now, the next study we want to look at, and I will put this chart into perspective after we take a look at this, the details I want to point out. We made the observation that for the first time since we drew the Andrews pitchfork, we actually exceeded and went above this upper prong, the zero prong right here, only to see it move back into alignment, kind of like a Bollinger Band, hitting this top end of the channel and then trading lower. Lo and behold, we've now weathered this sell-off for a long enough time period that, as you can see, we are now rather close to the next channel line. And with that in mind, we could absolutely see the following type of scenario. Let's go ahead and kind of compress this again and move it over. But what I'm talking about is, even if it's still in a downtrend, we had this nice rally to the upside, comes in here. If it finds support here and then takes off from this area, we would get really strong evidence that we're in a bullish rally as opposed to a counter trend once we exceed this prong. We talked about that again last week and the week prior. I was hoping that we'd get some sort of follow through. The follow through we got was lower pricing. But the fact is that we are back in this area right here, and it seems as though this is another logical point to look for a potential end to this most current correction. Now, there's a third piece of data that I want us to look at today to consider the possibility of a bottom coming into play next week. What I've done is I've gone ahead and I've pulled up our daily charts. On the right-hand side, we have Forex or spot gold, continuous contract COMEX gold. That's on the left side. And the reason for putting these two charts up is what we want to focus or look at right now is the actual candlestick that has developed on our daily charts. Traders realize one day doesn't make a bottom. However, we could see the market, which is, as I said, which has rallied considerably. It comes back down and forms some sort of a bottom here. There's a couple of candlestick patterns that we look for, and one of the primary patterns that we look for is either some sort of a morning star, which is a small bodied candle gapped below. You would get that on our continuous contract of COMEX. Of course, you're not going to get this on a 24-hour market, but you're going to get a star-like formation, and that, of course, would be followed with a confirming candle. Confirming candle would be higher low, higher high, and a green-bodied candle. And, of course, the green-bodied candle would be simply saying that it opens and then closes higher. And then this collectively would be our three-river morning star formation. Now, there are other bottom formations in the market, and simply put, in candlesticks, as the market goes down, you usually have that concluding red candle. That's going to be one of your final candles. Let me kind of put that in. So the market's moved down, you get your red candle here, and then there's a number of different patterns that can occur that are really signaling pivot points. We talked about this basic star formation. The next pattern that you could see is simply called a piercing line. And so on a piercing line, you would get the following candle after this downtrend to be a long green candle that opens below but closes above or at the midpoint of the prior candle. So that's one type. That's called a piercing line. And then there's another type which is simply called an engulfing bullish. Now, an engulfing bullish, you would open below and close above. It would completely engulf it. And then there is one third type, which is not nearly as powerful, but what that is called, simply put, is a harami. And I'll do that up here. A harami would be a red candle, and then the Western technicians simply label this as an inside trading day, in which you would have a small body in the middle. Now, of these key reversals, the strongest, of course, is really going to be your engulfing bullish. Second would be the variations off of Three River Morning Star. And when you look at that, this Three River Morning Star is an engulfing bullish that takes an extra day to kind of unfold. And so what we're looking for is any kind of a V that we get within the market. We are going to see either some sort of a long green candle, meaning we get the break back to the upside, or it will be a cluster of star-like candles, small body candles. And what that shows us is that the market's consolidating. It's that changing of power, that pivot point when the bulls nor the bears have absolute control of the market. And that's a point when the bulls can regain it. So you look for these small body candles. But those are some of the basic types of patterns that we look at as a market's been selling off to give us an indication that we could be looking at some sort of a key reversal. So traders, with that in mind, in other words, the potential for a bottom, I'm bringing up our longer term chart. This is a 2-day chart. However, we have our current Elliott wave count. This is one of a couple of the models that we're working with. And the reason that I don't think that this most recent correction caused long-term damage is because even if we concluded our long corrective wave down. We've entered our impulse wave. As I said, that's going to be a series of waves. So now we have 1. We possibly have the conclusion to 2. 3 is going to be of critical importance because 3 is going to take us above these prior tops. And by doing that, we'll also see it break above the Andrews pitchfork at the same time by it moving up. And so that's going to be a really, really most important piece of this puzzle, is to see what we get. If in fact the market recoups, it finds support right there, moves back up for a, call it wave 3 within this impulse phase, and where that might take gold prices. So I don't think we've seen long-term damage. I do think that this market is still moving within a stair-step manner that is quite logical and normal in a market. I would much rather see this. It's a much more predictable quality about a market that trades like this than opposed to a parabolic move, because a parabolic move, you just don't know when it's going to end, and when it does, you'll typically get volatile up and volatile down. So I do believe we haven't caused long-term damage. I also believe that there is a decent probability, I would say 65 to 70% probability, that we'll see some sort of a bottom towards the beginning of the week and enter our next trade. So what about silver? When we look at silver, this is a longer-term weekly chart. We've talked about the fact that unlike gold, we were never really able to break above this long-standing resistance. That is absolutely bearish sentiment. If anything, the best way to describe this market is what's called a descending top, meaning prices are moving lower, and actually a flat bottom, because we are having a real stabilization at certain points in the market. Now, in terms of any kind of bullish sentiment, what we can say about silver is 1958, and you know that I've talked about that as a pretty critical number. Although you do get pricing down to the high 18s down here, you can see that these are never done with really the bodies of these candles. Rather, they're the lows of the marketplace itself. You can see that in most circumstances, the bodies of these candles actually stays above this 1958. That to me is a critical area of support. But here's what I'm finding most interesting about silver. We're really getting to the apex of a compression pattern. And typically when you get to the apex, you get a release of energy, and that release of energy is going to propel the price sharply higher, or it can propel the price sharply lower. The fact that we're coming to the apex doesn't determine which way it will break out. What it does say is that the breakout should have a pretty sizable release of energy, and we should see a sizable price move. My sense is that if we're looking at gold with a potential bottom and we get confirmation of that and we see silver begin to move with it, we would look for a breakout to the upside, of course. So I believe that we're going to have a most interesting week next week. I think Monday, Tuesday, or Wednesday will probably, depending on what happens in the market, but if we get a continuation, a follow-through for what we're seeing towards the end of the week, and don't get any kind of selling pressure coming in on the onset of next week, we should see the potential for a bottom and a trigger to enter the market from the long side. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.